Welcome, ladies and gentlemen, to Boss Economics World, the only show where we take the dismal science, sprinkle it with a dash of chaos, and serve it up hotter than a central bank printing press during a recession. I'm your host, the Sultan of Satire, the Maestro of Markets, and the guy who thinks quantitative easing sounds like a yoga move gone wrong. Today, we're diving headfirst into the economic circus that is Europe's grand plan to dethrone King Dollar and crown the euro as the new global financial monarch. Spoiler alert, it's a plot twist juicier than a Netflix drama, but with more bureaucracy and fewer car chases. So, grab your calculators, your popcorn, and maybe a stiff drink, because this is gonna get wild. Folks, it's August 12, 2025, and Europe's policymakers are riding high on a wave of optimism, or is it delusion, as they dream of a world where the euro rivals the mighty US dollar. Why now, you ask? Well, blame it on the return of Donald Trump to the White House, whose tariff tantrums and Fed bashing have sent shockwaves through global markets. Investors are jittery, US Treasuries are looking less like a safe haven and more like a roller coaster, and suddenly, the euro is strutting onto the stage like a supermodel at Fashion Week. Christine Lagarde, the ECB's fearless leader, is leading the charge, declaring this the global euro moment. Sounds sexy, right? But hold your horses, because turning the euro into a serious dollar rival is about as easy as herding cats, especially when those cats are 27 EU member states with their own agendas, tax regimes, and sacred cows, looking at you, German Sparkassen banks. So, what's the big deal? Why does Europe want to crash the dollar's party? And what does this mean for you, whether you're a regular Joe worried about your savings or a Wall Street hotshot betting on currency swings? Let's break it down, Boss Economics World style, from the surface-level drama to the deep, dark economic underbelly. First, let's talk about why the dollar is the Beyoncé of currencies, flawless, untouchable, and running the show. Back in the 1960s, French Finance Minister Valéry Giscard d'Estaing coined the term exorbitant privilege to describe the dollar's dominance. What does that mean? Well, imagine being able to borrow money at dirt cheap rates, shrug off exchange rate volatility, and even weaponize your currency through sanctions, cough, Iran, cough, Russia. That's the dollar's superpower, and it's why the US can run massive deficits without breaking a sweat. The euro, meanwhile, is like the talented but overlooked sibling, stuck at a measly 19% of global transactions and 20% of foreign exchange reserves in 2024, according to the ECB's latest report. Compare that to the dollar's 60% share of reserves and 40% of transactions, and you see the problem. Europe's been green with envy for decades, and now, with Trump shaking things up, they think it's their chance to shine. But here's the kicker, wanting to be the cool kid on the block and actually pulling it off are two very different things. To dethrone the dollar, Europe needs to fix a laundry list of economic messes, fragmented markets, shallow bond pools, and political squabbles that make a reality TV reunion look civilized. Lagarde's got a plan, and it's ambitious, to say the least. She's calling for deeper capital markets, joint debt issuance, and a digital euro to boot. Sounds great on paper, but in practice, it's like trying to build a skyscraper on quicksand. Let's break down the economic issues at play, shall we? If the euro wants to be a global heavyweight, it needs deep, liquid capital markets where investors can park their cash without breaking a sweat. Right now, Europe's markets are a patchwork quilt of national systems, each with its own rules, taxes, and quirks. Want to invest in euro-denominated assets? Good luck navigating the maze of German insolvency laws, French tax codes, and Luxembourg's love affair with secrecy. Here's a fun fact, the combined bond markets of the eurozone are just a third the size of the US market, according to ECB data. And venture capital? Forget about it, Europe's VC funding in 2024 was a paltry $82 billion, compared to $176 billion in the US, per PitchBook. That's not exactly screaming, investor paradise. Lagarde's solution? Harmonize the rules, baby. Create a single capital market where companies can raise cash, investors can buy bonds, and everyone's happy. Sounds simple, right? Wrong. Since 2015, the EU has tried, and failed, over 100 times to make progress on this, thanks to national vested interests. Small countries like Ireland and Luxembourg are clinging to their financial fiefdoms, while German savings banks are terrified of losing their lending monopoly to big, bad capital markets. And let's not forget the lobbyists, those shadowy figures who make sure nothing ever changes. It's like trying to play chess with a board full of queens, and they're all working against you. Next up, Europe needs a Eurozone equivalent of US Treasuries, a safe, liquid asset that investors can buy without worrying about default. The US Treasury market is worth over $27 trillion, with more than 100% of GDP in top-rated bonds, according to the US Department of the Treasury. In Europe, just 50% of GDP in AA-rated sovereign bonds, per Lagarde's own stats. Ouch. The fix? Issue joint Eurozone bonds, where all 27 countries pool their credit and share the risk. Think of it like a group project, everyone chips in, and everyone benefits. Except, in this case, Germany's the straight-A student who doesn't want to carry Italy's dead weight. The idea of mutualized debt is political kryptonite in Berlin, where memories of bailing out Greece during the Eurozone crisis still sting. But here's the thing, Europe's already dipped its toe in the joint debt pool. Remember the €750 billion recovery fund in 2020? It was a game changer, proving the EU could borrow together to fund common goals. Now, with the Rearm Europe plan aiming to mobilize €800 billion for defense, there's talk of doing it again. If they pull it off, it could create a liquid, euro-denominated bond market that rivals treasuries. But if history's any guide, don't hold your breath, Europe's promises are like New Year's resolutions, big on hype, short on follow-through. Oh, and let's not forget the ECB's shiny new toy, the digital euro. Lagarde's betting big on this, hoping a central bank digital currency, CBDC, will boost the euro's global appeal. The idea is to make cross-border payments faster, cheaper, and less dependent on dollar-based systems like SWIFT. But here's the catch, China's already miles ahead with its digital yuan, which is being tested in 23 cities and used in over $250 billion worth of transactions as of mid-2025, according to the People's Bank of China. Meanwhile, the US is dragging its feet on a digital dollar, with Fed Chair Jerome Powell calling it a low priority in a recent speech. Europe somewhere in the middle, with the digital euro still in the planning phase. Will it be a game changer? Maybe. But only if Europe can get its act together on the other fronts first. Now, let's flip the script and talk about why the dollar's looking vulnerable. Trump's back in the White House, and he's swinging his tariff hammer like Thor on a bad day. His latest move? A 25% tariff on European cars, announced in July 2025, which sent the euro surging as investors bet on a weaker dollar. Meanwhile, his attacks on the Federal Reserve, "They're a bunch of clowns," he tweeted last week, have spooked markets, with U.S. bond yield spiking to 4.8%, the highest since 2011, per Bloomberg data. Investors are starting to question whether US Treasuries are still the ultimate safe haven. A recent Natixis survey found that 68% of strategists now see Treasury market turmoil as the top global risk, up from 42% a year ago. And with the US debt to GDP ratio hitting 130% in 2025, according to the Congressional Budget Office, the dollar's exorbitant privilege is looking more like an exorbitant liability. So, what's the takeaway for the average viewer? If you're a regular person worried about your savings, a stronger euro could mean cheaper imports from the US, think iPhones, Teslas, and Netflix subscriptions. But it could also mean higher borrowing costs if Europe's bond markets tighten up. For the finance pros out there, this is a golden opportunity to hedge your bets. Currency volatility is at a 10-year high, with the euro-dollar exchange rate swinging 15% in the past 6 months, per Reuters. And if Europe does manage to deepen its capital markets, euro-denominated assets could become the next big thing. But here's the Boss Economics World hot take, don't bet on Europe pulling this off anytime soon. The euro's got potential, sure, but it's up against a dollar that's still the world's default currency, a fragmented EU that can't agree on lunch, let alone joint debt, and a political system that moves slower than a snail on vacation. Well, folks, there you have it, the euro's big dream of global domination, brought to you by the same people who gave us Brexit, Grexit, and a million EU summits that end in, "We'll get back to you." Will the euro rise like a phoenix, or crash like a bad rom-com sequel? Only time will tell. Until then, keep your wallets close, your investments diversified, and your sense of humor intact. This is Boss Economics World, signing off, because in this economy, laughter is the only currency that's still inflation-proof.